Good afternoon, Dongjun. Good afternoon. How are you?
I'm doing okay. How about you?
I'm good, thank you. Thank you very much. Good afternoon, everyone. Hello, Chongin. Hello, Tantra. Hello, Benedict. Hello, Yana, Mary, Gung, Keun. So nice. The weather is great, right? You guys feel like going somewhere rather than taking classes, right?
Good afternoon, Professor.
Good afternoon, Tan.
You can call me Thanh
Tantra?
Yes.
Tantra. Tantra is surname?
No, it's not my surname. Nguyen is my surname.
Okay. Tantra is okay. So you are from which country?
I'm from Vietnam.
Vietnam.
Yeah.
Wow, Vietnam. Which city?
Hanoi.
Hanoi. Hanoi is located in the northern side of Vietnam, right?
Yes, it's on the northern part.
Capital of Vietnam?
Yes.
Oh, okay, great. Hanoi, and what's the next? What's the name of the second largest city in Vietnam?
You mean Ho Chi Minh City?
Ho Chi Minh. Ho Chi Minh.
Yeah. Actually, Ho Chi Minh City is biggest one, even bigger than Hanoi.
Sorry.
Yeah.
Okay, I've been to Vietnam just once, so I don't know much about Vietnam, but I like it to copy in Vietnam.
Yeah, it's quite like a really, how can I say, like it's the signature things in Vietnam.
Yeah, the Vietnamese people love coffee, right? They
Yes.
love drinking a cup of coffee. So I saw many. It was just after a lunchtime, so I saw many people. There was a lot of coffee shops on the street. So many people were sitting inside a coffee shop and drinking a cup of coffee. Yeah,
That's true. It's kind of like the big part of Vietnamese culture.
Maybe I don't know where does that tradition come from, but maybe I'm not sure if I'm right, but maybe the influence during the French colonization back, right? I don't know, but just because Vietnam grows a lot of coffee beans, right? That's the reason, right?
Yeah, I think so.
Yeah, that's the reason. Sorry. Yeah. Actually, everybody loves. Many people loves drinking coffee. Yeah, not just Vietnamese people. Okay. Nice to see you guys again. The weather is great. I think the weather is in Daejeon also fabulous. Okay, so in the morning I sent you guys an email, the invitation email attaching answers to the examples and exercises from previous classes. So if you have any questions related to the answers, then please contact me without any hesitation. Then I'm gonna be happy to talk with you guys. Yeah. Okay, today we are going to continue to talk about equities. Equities is simply speaking stocks, okay? The stocks, equities, not always the same in terms of meaning, but if you talk about common stock, then most likely equity has the same meaning as the stock if you talk about common stock, because common stock usually has the voting rights. Okay. Preferred stock is a little bit different from common stock in terms of ownership and voting rights. Okay. This is the first front page of Wall Street Journal I took this morning. As you can see, all the indexes, U.S. indexes, are declining. It declined yesterday. Dow Jones Industrial Average, S&P 500, Nasdaq, Russell 2000. While the stock index has fallen, the treasury yield rate, 10-year yield rate, has increased, right? And the VIX is the volatility index, and gold, gold price was declined. Usually, when the stock market is not good, then the price of gold goes up, right? And Bitcoin, a little bit increased, and the crude oil is keep losing its ground. So as you can see, the stock market is tumbling, right? Dow closes in a bear market as stock decline. There are many reasons behind these declines in the stock market, but one of the biggest reason is the inflation, right? Inflation is spreading around the world. So the central bank, including Federal Reserve Bank in the US, is keep raising interest rate, which has negative impact on the stock market, right? Okay. Any question related to this front page? No? Okay. Yeah, equity valuation is still extension of time value of money, which basically means present value and present value of future value or present value of cash flows, right? So when it comes to equity, what is gonna be the cash flow coming from equity, the stock? So if you purchase a stock, right? So you want to expect a return from the stock you purchase, right? So then the return comes to you in dividend distribution or a capital gain as far as the stock appreciating since your purchase of the stock. Okay, so cash flow from the equity, if you keep holding the equity, the cash flow from the equity is dividends, right? Dividends is the single source of cash flow. There are other ways of distributing profits, other ways of company distributing profits to the shareholders, not just the dividend, but also share buyback or stock dividends, something like that. But just to for the simplicity, we gonna only talk about the dividends in terms of the cash flows from common stock, the equities. Okay, then yeah, it's pretty simple. Okay, so as far as we know, the cash flow, right? So then we may be able to make a valuation of the stock based on the cash flow and what? Discount rate. We need discounts, right? Future cash flows to the present. Then we can see what the value of the stock is now. And you compare the value with the price of the stock. So you make a judgment whether the current price of stock is overvalued or undervalued in comparison with your valuation of the stock based on the cash flow of the future cash flow of the from the equity from the stock. So it is very subjective, right? Everyone has different forecasting of the future cash flows and the discount rate related to the stock. That's why they keep changing ownerships of the stocks every day, because they have different expectations, different forecasting, different valuation of the stock. Okay. So just for refreshment, future value is present value multiplied by 1 plus interest rate or discount required rate of return, right? And present value is future value divided by 1 plus interest rate or required return. The future value is expected value of the cash flows in the future or future dividends expected from the common stock. So future value of the stock equity is the or future dividends expected from common stock. Okay. You guys know this formula, right? Familiar. The one of the most popular model for equity valuation is dividend discount model. Dividend simply dividend discount model. The dividend is cash flow, right? And discount. So we want to discount this cash flow. Then we can drive value of the shares. So discount rate. Using discount rate, we discount the future cash flow. Okay, so then we have a value, present value, right? And then we compare present value of the stock versus price of the stock. So this price of the stock, when I say price of the stock, this means that the current price in the market, okay, the market price. So as far as the market price of the stock is available, right, and you are able to make a valuation of the stock, you can compare the two, right? So then, if the value is higher than the market price, then the market price of the stock was undervalued, right? But if the price is higher than your valuation of the stock, then the stock is overpriced, overvalued. So any investors with common sense would not purchase the stock, overvalued the stock, right? They would not sell the overvalued stock. And they want to purchase the undervalued stock. Okay. That's the point of a valuation of the stock, right? So present value of stock, this is the key, this is the main point. This is the main purpose, our main purpose. The present, if we calculate, if we are able to calculate the present value of the stock, then yeah, that is going to be the value of the stock. How we can get the present value of stock? Simply we divide, we discount all future dividends expected common stock by required rate of return. Okay, over the period, over the holding period, over the holding investment period. So then you may ask, how can you get all future dividends expected from the common stock? You probably first refer to the past dividend payment history, and based on this information, you can also you can also forecast the growth rate of the growth rate, expected growth rate of the stock, and profit, something like that. So based on your future forecast of the company, you can also drive. You can also drive the future dividends. Okay. So we are going to talk about we are not talking about this part, but just theoretically, you should understand. Theoretically speaking, first you refer to past dividend payment, and then we just assume that we are given the growth rate and the profits. Okay, for this for the purpose of this class. The dividend is paid out by the company, okay, out of profit. You know what dividend is, right? Because as an investor, you participate in the company. As an owner of the company, you participate in company, holding shares, right? So then, based on the performance of the company, part of the earnings go to the shareholder, which is called the dividend. Okay. But if you sell the stock, then the dividends will come to you in the form of capital gain. Okay. So if you sell the stock, then the part of the return from the sale of stock is actually dividends, realized dividends, right? Even if we call part of the return from the sale of the stock is called the capital gain, but the actual the capital gain in terms of the cash flow, so it's the same as dividends, as if you still keep the stock. Okay. So let's see. Let's say you just purchased the stock. Okay. And just 1 year, after 1 year, you sold the stock. Okay. You just hold the stock just only 1 year. Then you want to expect the dividends from the company okay? And then you're gonna expect the sales price, okay, of the stock. So then this is gonna be the cash flow, right? So then if you divide these two cash flows with 1 plus recurring rate return, then you're gonna have present value of the stock. So this is just a estimation, okay? This is the expected value, value. So based on the information on the company and the past history and the financial states, all sorts of information, you're gonna expect some dividends in 1 year, and you wanna expect some you want to expect the sales price, the price of the stock in 1 year, right? So if you assume you sold the stock in 1 year, then this is gonna be the cash flow you wanna get from the sales of stock, right? And this is a dividend you wanna expect at the end of the year when the company make dividend distribution. So this is all the cash flow you're gonna have if you keep the stock only 1 year and sell the stock at this price, right? So if you divide this, let's say this discount rate is annual rate. So if you divide this annual rate, if you divide the cash flow with this annual rate 1 plus R, then you're gonna have the present value of the stock. Okay, theoretically. Understand? Any questions?
Professor,
Yeah. Go ahead.
why does the T represent part of the selling price? I thought it represents the whole. It's just to represent the selling price. Why is just a part of it? I was a little.
Well, so let's say right. So let's say you're interested in okay, you're interested in the company Facebook, okay? So you purchased the Facebook, 1 share of Facebook, $100 at $100, right? So then in 1 year, you're gonna receive dividend, let's say $5, okay? Pretty generous. And then you wanna sell this stock, right? Let's say 105. Okay. So this stock has appreciated the price. So okay, we have a $5. Okay. And then your initial investment is 100, and the capital gain is $5 from the sales of these shares. So total 105 in 1 year. Yes, this one also, before you at this point, right? At this point, this one is also the present value of future dividends, right? So basically, the 105 is all about the present value of future dividends, right? So where technically speaking, yeah, you're right. So maybe it was just realized as a kind of a capital gain, as part of the capital gain, right? So this is partly capital gain, okay, and partly dividends, okay, and this initial price $100, right, is also actually this is this $100 is you actually made investment and you got return of $100. So where it just kind of it's when it comes to return, right? This initial investment may be deducted, right? So, but in terms of a valuation of the stock, this $100 at point 0 still present value of the future dividends. Okay, discounted at this recurring rate of return. You get it?
Okay, yes, thank you.
Yeah. So okay, forget about this. So just technical speak, yeah, to be more precise, to make things simpler, just understand the value of the stock as the present value of future cash flow, which is dividends, right? Yeah, but most people do not keep the shares indefinitely. At some point, they sell the stock, right? So then they may realize the capital gain, but the capital gain realized is also it could be also dividends that was not disputed during the holding period. Okay, and the part of the sales price actually comes from your initial investment, right? If the stock has appreciated, as far as the stock has appreciated, right? So, but in some cases, you may lose some of the investment if the stock depreciates. Okay, so there was another, someone else who wanted to ask question. Who was he?
No, I said I don't have any question, just to answer your question.
Okay. Okay, so let's move on. This is P1 or P0, the price of the value of stock at present, right? This one is price of the value of the stock year 1, right? So the only difference is that we discount. We are talking about present. We are talking about the value of the stock at year 1, right? Not we just talk about the value of stock year 0, right? But this one is the value of stock year 1. Then we have to discount the dividend you want to expect receive in year 2 plus price of the stock in year 2, right? So if you discount these two cash flows, then you're gonna have value of the stock in year one, right? Okay, so if you replace this variable of stock in year one with this formula, right? Then you want to have this one. You get it? Right? Pretty simple. It looks a little bit confusing, but pretty simple, right? We don't know this, we just use this same formula to get this value of stock in year one, right? That's all, right? Okay. So it goes on and on. As far as you, yeah, theoretically it goes on and on because equity does not have any maturity. Equity does not mature, right? The fixed income bonds has the specific maturity, but equity doesn't have a maturity. So as far as you keep holding the equity, right? So then, yeah, it could go on and on. So then, yeah, it goes like this, right? So then you may recall the math class in your high school, right? Like this. You guys recall this number threes, right? So then this one, right? And then this one, right? Not much different, right? Not much different. Okay. If you look at this, right? Not much different. So but here T0, let's say T0, yeah, from here, so we need to make some assumptions to make these number series into simple formula, okay? Especially this D1, D2, D3, right? We just assume that we're gonna have a different D1, and we're gonna have a different D2, we're gonna have a different D3, right? So we do not have any. We didn't set any rules on this dividend, so it's a little bit hard to simplify these series into a formula, right? You understand what I mean? So anyway, so there was a man called Gordon. So he come up with some ideas. Okay, the idea is that, okay, the future dividends is gonna grow at a specific rate. Okay, so Gordon come up with some idea, some idea of constant growth rate of dividend. So then you can put some order into this number series, especially this one, because we're gonna use the same recurring return, right? But we do not have any we didn't set any natures of the changes in dividend between D1, D2, D3, D4, D5, right? But what he has done is what he has done is to set orders, to set some rules into the changes of dividends, which is called the constant growth rate of dividend. So this is it. Okay. Okay, D1 is D0, let's say. We are now, let's say 2021 December. Let's assume that you have dividends from now basically it's called Meta, right? Meta, right? And let's say 2022, what is gonna be the dividends? So this is the dividend D0 that you wanna know the dividend from the Meta in 2022. So well, let's assume that the growth rate of the company, right? Growth rate of company, let's assume that is 5%. So Meta is gonna grow in terms of profits, okay? That's the companies grow at 5% annually. Just assume that. So then his dividend also gonna grow let's assume that at the same growth rate, 5%, right? So then this dividend is gonna be 1 plus 5%, right? Then you're gonna have right, 10.5. 10.5 is gonna be dividend you expected in D1 in 2020 December. So during this period, the performance of the company is in terms of growth rate is 5%. So you apply this growth rate to the dividends as well. So now we can get the idea of how to calculate future dividends based on this growth rate. You get it? What does silence mean? Oh, please. What does silence mean? You guys understand or not? Kyungjun?
Yes.
Kyungjun? You're there? Yana? You're there?
Yes, I'm here.
So how about you?
I'm confused because I don't understand how we can use it. Like, okay, there is formula and what we can do with it.
Oh. Or why you don't understand why we are doing this?
I don't see the application for the formula because like I pretty understood how it works, but I don't know how I can use it in the task to solve a task or in real
So
life.
you want to know the purpose of this calculation, right?
Yes.
Yeah, basically. Yeah, so I tried to move on a bit smoothly from this from this to this. Actually, this one, right? This formula supports this formula, because as I said, okay, hey, you guys understand this one? How do you guys understand how we you guys understand how we ended up like this in terms of valuation of stock? You guys understand? That should be the starting point.
It is the formula of how we like all cash flows that come each year.
Yeah. So
going
yeah.
back to like the present value.
Yeah. Perfectly, you know perfectly where, right? This is a cash flow, right? Every year. And this is the discount rate, right? So you see, discount rate does not change. We do not use discount rate year 1, year 2, year 3, year 4. No. Theoretical. This is very theoretical, okay? And the theory is based on a lot of assumptions. Otherwise, there's no way to settle a formula, okay? So in this formula, we are going to discount future cash flows, right? At the same discount rate, right? But we don't know. But as far as the future cash flow is different from one another, there's no way to calculate how to say. It's going to be pretty difficult because we have to keep discounting the different cash flow indefinitely, right? So it's really the economists really loves formula. They like to come up with some formula based on their assumptions, right? So okay, so how about put some order into this cash flow, D1, D2, D3, D4, D5, right? And so the economist Gordon, I don't know his full name, the Gordon come up with some order between these cash flows. Let's say dividend 1 is the same as dividend 0 multiplied by 1 plus growth rate. Okay. So then we are gonna have, if we use this assumption, then you're gonna have some kind of order like this in terms of cash flow. Okay. You guys understand? Why do we this? Because we want to, in the end, have some formula like this. This is the final result. But
I have a
before,
question.
sorry,
I have a question. How dividends are calculated? It is a percentage of what?
percentage of growth rate.
No, dividends.
Sorry, what was your question?
How dividend is calculated?
Oh, dividend. How? Well, dividend is not calculated. Dividend, the dividend is distributed by the company based on this performance, right? Based on the profit. So here, yeah, that's very good question. So we don't know what the dividend will be in year 1, year 2, year 3, year 4, year 5, year 6, right? On and on. We don't know. So that's why if we simply expected some future dividends, if you simply expected some dividend in the future, then it is pretty difficult to make a valuation of the stock because we don't know the exact numbers of future dividends, right? So for the valuation purpose, right? For the valuation purpose of the stock, we assume that based on but we know the current dividend amount, right? At least we know the current dividend amount. So let's say current dividend, let's say 2021 December, right? So let's say you have the stock of Facebook, right? But you know the most recent dividend amount from the company. Let's say it was $10. At least you know the most recent dividend amount, right? So using that amount, dividend amount, you expect some growth rate of the company. So what is gonna how much the dividend is gonna grow? So you don't know what the future dividend will be, but at least based on the historical performance and economic circumstances and the business strategy of whatever of the company, you may expect, which is pretty subjective, you may expect some growth rate of the company. So whatever the growth rate is, let's say the growth rate is G. Okay. So the companies grow. When the company grows, then the dividend is gonna also grow at a similar way, in a similar way, right? That's why this growth rate is applied to the most recent dividend amount. So then you can calculate what the future dividend in year 1, if you multiply just one time. I mean, here the another assumption is that the growth is going to be constant, right? So we have many assumptions, right, to make some kind of a formula, to come up with some formula, right? So this this growth rate is constant, okay? So if you multiply the dividend growth rate G with the most recent dividend, then you're gonna have future dividends. If you multiply just once, then as far as this growth rate is annual growth rate, then you're gonna have dividend amount in year 1 from this formula. You get it? No. Still
More or less, yes.
more or less. Okay. How about yeah. So this is very important.
So it is like we trying to calculate the amount of money that we will receive if we buy this share in 1 year, right?
Say again.
It is amount of money that we try to calculate how much money we will be given if we buy this share in 1 year. So we buy a share now, and in 1 year we can have D1 dividends.
Yeah, based on our assumption on the growth rate, this growth rate, we expect this dividend in 1 year. If you multiply this growth rate with the most recent dividend amount, this is the expectation. Expected dividend in year 1, but the actual dividend amount would be definitely different from this calculation.
And where can we get this G?
G, as I said, G is a growth rate, right? Growth rate is usually, sometimes we use GDP rate just to be safe, okay? Sometimes, but you can, here, the growth rate G is assumed to be okay, not growth rate is long-term growth rate. Okay, so we talked about Meta, the Facebook, right? So Facebook is IT, one of the IT companies. So you may take some guess of the IT industry growth rate, or this is very, if you actually wanted to calculate the growth rate, that is going to be very, very time consuming work. So, you know, the analysts, right? The security analysts, they put huge amount of time, spending huge amount of time analyzing the growth rate. One of the formula of calculating growth rate is earnings, multiplication of earnings retention rate with return on equity. This is one of the way to calculate growth rate. But for now, for the understanding, for the purpose of understanding the valuation of the equity, it's okay to forget about how to calculate the growth rate. Okay, it's okay to forget about how to calculate the growth rate. If you really just I'm going to explain to you some kind of a logic behind this later, but for now, you guys should understand. You guys assume that okay, there's some growth rate of the company, and that growth rate can also be applied to the growth of dividends, right? That's all for now. So then, based on that assumption, now we can calculate kind of a future dividends using this formula. D1, if you replace this is D1 dividend, D2 dividend is D1 multiplied by 1 plus the growth rate. and D1 growth rate and D1 dividend can be replaced with this one, right? And then, so D2 dividend, year 2 dividend is the same as the most recent dividend multiplied by 1 plus growth rate square. You guys understand this formula? This, you guys understand the flow of this calculation?
Yeah, yes, perfect.
Yeah. So then it goes like this. It goes like this. And then if you, so it looks like, if you understand this, if you apply this formula to, if you use this formula, then you can calculate in the end this one. Okay. So I could say, hey guys, you just try to memorize this one, but it'll be better, a little bit better to have some understanding behind this formula. Okay. Then you guys have a more lasting memories of this formula, because basically this formula is a bit important in solving some problems related to the evaluation of equity. This one is, if the growth rate 0, let's say G is 0, then the initial dividend D1, right, is gonna be the future cash flow, right? The future cash flow is the same as the most recent dividend amount. So if that is the case, then if you simply divide the most recent dividend amount with the recovery return, then you're gonna have the value of the stock. So this is the formula when the growth rate is 0, which means G is 0. You guys understand? Any questions? I'm gonna also take some break. Yeah. Yeah. This is called golden growth model. This is called the golden growth model. Why? Because Gordon come up with this formula. So don't blame me, but blame Gordon for for this complicated process. I think, but basically he simplified the valuation process. Yeah. So the golden growth model actually incorporates future dividends and the growth rates into the valuation of the stock. So future dividends can be calculated using the growth rate, constant growth rate. It is relatively simple and pretty well recognized. Okay, dividend discount model. So dividend discount model is more broad concept. Okay, more broad concept, and the golden growth model is a bit narrowed down the model into more specific way of calculating the value of the stock.
Sir, I have a question.
Yeah.
So pretty much the golden growth model and the dividend discount model is same thing.
Basically, conceptually same thing. Conceptually same, but the difference between golden growth model and dividend discount model is that golden growth model puts some golden growth model put some orders into the cash flow, dividend cash flow, using constant growth rate. That's the difference. So dividend discount model is much the same as the concept of time value of money, right? Not much different. So dividend discount model is pretty same the time value of money in terms of concept, because time value of money is just it's especially present value, right? If you want to calculate present value, you keep discounting the future cash flows at this recovery rate of return, discount rate, right? Dividend discount, but also to calculate the value of the stock, you keep discounting the future cash flow, which is dividends from the stock at the discount rate R, right? But so conceptually, the present value of the discount model is almost same. But the only difference between golden growth model and dividend discount model is that golden growth model has some assumption, which is dividend is gonna grow at a constant rate. That is the difference. So thanks to this assumption, we can come up with this formula. 명섭, you get it?
Yeah, I understood.
Okay. So don't pretend you guys understand everything. So if you don't, then please ask me, like 명수. Yeah. Okay. I think this is the most easiest way to explain golden growth. I don't know. There are some pros and cons of a golden growth model. Did I? Okay, sorry. The intrinsic value is the present value of the constantly growing perpetuity. So yeah, basically, if you calculate the present value of future cash flows at a constant rate of growth, then you're gonna have the intrinsic value of the stock. So assumptions of golden growth model is dividends are correct metric to use for valuation purposes. Okay, that's the first assumption. Dividends is the most important part of the valuation, and the dividend growth rate is forever and forever and never changes. That's the assumption. Okay, but this assumption is going to be actually lose in reality. That's why many people, I mean, there's many other techniques to value the stock, and the recurring rate return is also constant over time. Okay, so growth rate and recurring rate of return are constant. Okay, over the time, and dividend growth rate is strictly less than recurring rate of return. So you expect the rate of return is always higher than the growth rate of the stock. So which means that you have a higher expectation than the company's growth. Okay, which is pretty reasonable, right? You are very you expect more from the company, right? If you expect less than company, then the company's growth, which is a little bit unreasonable, right? But that could have happened actually, but as assumptions, this is pretty reasonable, right? Okay. If the growth rate is higher than your expected rate of return, then you're going to have negative value, right? Okay. Pros and cons. Actually, this is relatively easy, okay? And the one problem is that this golden growth model usually applicable to some stable company, stable companies which is kind of more sure, so that regularly make a distribution, dividend distribution. So in case of rapidly growing companies like Coupang, right? They do not actually make dividends. So it is pretty difficult to make a valuation of Coupang stock based on this golden growth model, because they haven't yet distributed any dividends to the investors, to the stockholders, because they are keep making investments, right? So then you should take different types of valuation techniques that is discounted the growth rate. So the golden growth, the golden growth model is just one of the ways to value stock. Okay, this is not the absolute way to make a valuation of the stock. Just one of the ways. Okay, there are a huge number of ways to value the stock. Variations to golden growth model. Non-constant multi-stage growth rate. But in the end, we're going to have a constant growth rate. So let's say for some period, we are going to have non-constant growth rate. So as you can see here, year 1, year 2, year 3, we have dividend. In year 1 we have $1, and year 2 $2, year 3 $2.5. So there's no regularity, right? The difference is $1. The difference is $1.5, right? But from year 3, the growth rate is constant at 5%. Constant growth rate, 5%. Let's assume that. So this period is non-constant growth, non-constant growing period. This is just to put some give some kind of variations to the golden growth model. So during this period, you should discount these cash flows at a discount rate separately. But from year 3, because of the constant growth rate, you can apply the golden growth model. Okay. From year 3. So here, constant growth rate, 5%. So year 3, if you want to calculate the price of the stock, you multiply. Previously, you just replace it. This so you want to know the cash flow. Okay, 1, 2. Year 1, year 2, year 3. Okay. We know the cash flow year 1, right? Dividend, right? We expect dividend year 1 is $1. We expect dividend year 2 is $2. We expect dividend year 3 $2.5, and it's gonna grow. It's gonna grow at 5%. So then we want to know the value of this stock at 0.0, right? So year 1, year 2 is the growth. The dividend is not based on this growth rate, right? This cash flow is a separate, a little bit separate. This cash flow is when it comes to growth rate. When it comes to the application of growth rate, this dividend is not subject to this 5% growth rate, right? So we should simply discount these cash flows at a required rate of return. So we discount this cash flow in year 1, year 2, applying required rate of return. Okay. Year 1. And right. So then we have right, plus two times, right? Then if we add present value, if we add the this part, right? Discount the value of this part, then you're gonna have the present value of this stock, right? We discounted the cash flow of year 1, year 2, right? So now we need to cash flows from year 3 till the year 3 until definite period. If you discount cash flows from year 3 to the present, then we have, if you added those 3, right? 1, 2, 3. Then you're gonna have the value of this stock, right? This is the 1, 2, 3. Okay. So then how we calculate this one, this part? Just assume that we don't have this part. Then let's assume that year 3 is 0, right? Just assume that. So then what is the most recent dividend amount in year 3? 2.5, right? 2.5. And Oh, this one should be also discounted. I forgot. Yeah, this one should be also discounted. Right? So then we need to know the value from we need to discount the future cash flow from at least from year 4 and 5, 6, yeah, indefinitely, right? So let's say the value of the future cash flow is right. So from this period grows every year 5%, grow at 5% in terms of cash flow. Okay, so we need to discount this portion of cash flows, right? From year the cash flows from year in year 4, 5, 6, 7, and 9, 10 indefinitely, right? So let's say the price, the value of this period is P3. Why? Because 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 P3 is the let's say let's assume that P3 is the present, right? So then this is a future cash flow, right? In year 4, year 5, year 6. So if you discount these cash flows back to the year 3, right? So then yeah, back to the year 3 first. So it's sort of a present value in year 3. Okay. If you discount the cash flows in year 4, 5, 6 to the period year 3, right? This is kind of a present value in year 3 of the cash flows from year 4, 5, 6. So now once we have this value, you wanna discount this value back to year 0. Okay, so if you add this 1, 2, 3, 4, then you're gonna have the value, present value of the stock when it has some period that is not applicable to this growth rate, constant growth rate. You get it? You guys get it? Yana, you get it?
not really.
Sorry?
I'm not sure that I get it. I'm just really tired after 1.5 hours. I just cannot think now.
Okay, okay. So take your time, and just try to follow this formula, thinking about the process of calculating the present value, right? Which is basically discounting the future cash flows and the recurring rate of return, right? So you should also keep in mind these assumptions, okay? And as I said, you also need to understand why we need to have this constant growth rate. You should understand why we have this constant growth rate. If we do not have this constant growth rate, then we have to have this process of discounting each dividend, expected dividends in each year, we should make this discounting every year, right? So it is a impossible process. So reasonably speaking, where companies show some constant growth rate. So based on historical research, the rate of growth, not just company, but also country, the GDP growth rate or company growth rate shows some kind of consistency, right? The historical performance is not much different from future performance. Future performance is based on historical performance, mainly. So you guys know your friends, right? So then if you know very well your friends, then you guys expect some kind of reaction from your friends to some kind of situations, right? If you know very well your friends, if you say something to your friends, you may expect some kind of reaction, typical reaction from your friend. Likewise, if you know very well about the company, then you can expect some kind of a growth of the company. So that's why Gordon, come up with this kind of formula of calculating the forecasting the future dividends based on the historical dividend and growth rate. Then we can calculate using this formula. We can calculate the value of the stock, intrinsic value of the stock, and this is just one variation. There's sometimes the company experience some non-constant growth of dividends. So take that period into account. We have this this kind of calculation, but essentially this is just a period of calculating present value, and this is the period where we apply golden growth model. Understand? I hope so. If you do not, then please email me. Okay, so we wanna take some example, and yeah, some example in the next lecture, and we have more to go. So please take your time and review this golden growth model, dividend discount model, and the golden growth model. Okay. Any questions? Okay. Okay. So thank you. Thank you for your participation, and see you this Thursday. Okay. Take your time. Okay. Thank you.
Thank you. Goodbye, Professor.
Thank you.
Thank you. Bye-bye. Sorry.
Thank you.
Okay. No question. Okay.
교수님 저 질문 하나.
Yeah.
그 오전에 그 이메일 보내주셨다고 하셨는데,
Yes.
네, 제가 그걸 못 받아서 혹시.
Oh, you are not on the list. You didn't receive my invitation email.
No.
Oh, really? Just a minute. Just a minute. I need to check some. Yeah. Just a minute. 명섭. Your name is 명섭.
네, 명섭 이명섭.
명섭. Okay, you know my email address, right?
Yes, sir.
So please send one email. Then I will put you on the list. Okay, just in case.
Okay.
So then I will send you again the email and attaching the the wire. Okay.
Okay, thank you.
Okay. Thank you. Okay. Thank you, guys. Bye bye.